Welcome back to Investing Talk Podcast.
Today, we're looking at BigBear.ai.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. BigBear.ai. They just put out their Q3 results, and honestly, the story here is really contradictory. It feels like a classic case of, beating expectations that were already pretty low, while the bigger picture looks a bit soft.
Exactly. The headline numbers look good enough to, stop any real panic.
Mhm.
Revenue came in at $33.1 million.
Which beat the consensus, yeah.
Yeah.
Analysts were looking for closer to 31.8.
Right. And the bottom line, that told a really dramatic story of improvement. They went from a $15 million loss last year to a net income of $2.5 million this quarter. So initially, you can see why the market got a little excited.
But that's just it. You have to peel back that first layer, because when you do, the foundation starts to look a little shaky. That $33 million in revenue, it's actually a 20% decrease year over year.
A 20% drop. So this isn't a stabilization, it's a contraction.
It's a contraction, and it's driven by volatility in their government work.
And they were pretty clear about that, weren't they? It came from lower volume on some key Army programs.
Exactly. These are huge long-term contracts, and they can fluctuate. But when just a few of them make up so much of your business, those fluctuations are, they're a huge risk.
And the margin story just reinforces that, right?
Yeah.
We saw gross margins compress.
They dropped from almost 26% last year down to just over 22% this quarter. And when you're basically a systems integrator, your margins are already pretty thin, so any hit to your high-value contracts is going to hurt.
So we've got this real tension. Shrinking revenue, squeezed margins, but the stock has been, it's been surprisingly resilient. So what's bridging that gap between the operational reality and, the market's enthusiasm?
It comes down to one thing: the balance sheet. It is the single most important factor here.
Oh.
The company is holding a record $715 million in cash and investments. This isn't just liquidity, it's a war chest. And it's designed specifically to pivot the entire business.
$715 million. For a company this size, that is a staggering amount of money.
It is, and a big chunk of that came from a recent capital raise, a stock offering that brought in about $337 million in gross proceeds.
So they deliberately diluted shareholders to raise this cash.
They did. It signals a major pivot. They're going from defense, just trying to stabilize their old contracts, to offense. They're weaponizing that cash to buy their way into a higher margin, software-focused model.
Because the outlook for their current business is still pretty tempered.
Very tempered. They're keeping their full-year revenue guidance at $125 to $140 million. And while that signals stability for now, it's a huge step down from what they were forecasting earlier in the year. The market knows organic growth is a struggle, so they have to go out and acquire it.
And that takes us directly to the biggest catalyst, doesn't it? The centerpiece of this whole new strategy. The deal to acquire Ask Sage for $250 million.
This is everything. This isn't just a simple purchase. This is them trying to fundamentally restructure the entire company.
So let's break that down. Why is Ask Sage so critical?
Well, the whole vision is to shift to recurring software revenue, right? Ask Sage is basically a turnkey solution for that. It's a fast-growing generative AI platform, but, and this is the key, it's purpose-built for super-sensitive environments. We're talking defense, national security, all of those highly regulated sectors.
And it's the regulatory side that's the real moat here.
It's the whole game. Ask Sage is model agnostic, so it doesn't care what AI model you use. But it's one of the only Gen AI platforms with FedRAMP High accreditation.
And for anyone who doesn't spend their days reading government procurement docs, that FedRAMP High is the absolute key to the kingdom, isn't it?
It's everything. It means the platform can handle the most sensitive, unclassified data. The kind of data where a breach would be catastrophic. It's not just a security badge. It's the regulatory pass that lets government agencies deploy AI right now in secure environments. It solves a massive bottleneck.
And they already have traction. They're not just buying a piece of tech, they're buying an existing ecosystem.
A big one. It already serves over 100,000 users across thousands of government teams. 27 agencies plus hundreds of commercial companies.
What about the growth? Compared to BigBear's shrinking numbers.
It's staggering. Ask Sage's annual recurring revenue, their ARR, is projected to hit about $25 million in 2025. That's a six-fold increase from 2024.
A six-fold increase. Wow. That's the kind of high-velocity software growth they've been missing.
Exactly. So the synergy is obvious. Big Bear can immediately start cross-selling Ask Sage into all their existing government accounts. They take this high-demand platform and wrap their integration services around it.
The timing feels very strategic, too. They're not positioning for today, but for what's coming in 2026, 2027.
Right. They're preparing for that expected spike in government AI spending. They want to be the default secure platform when those floodgates finally open.
And they're bringing over the founder, Nick Shalin, as the new CTO. So it's not just the product, it's the talent.
They're integrating the domain knowledge at the highest level, but this whole $250 million bet, it's all about that transformation, and that's exactly where the risk comes in.
I agree. Let's talk valuation.
Right.
Because this is where, a skeptical investor might raise an eyebrow. Even with Ask Sage's growth, the stock trades at a really high price-to-sales ratio. We're talking in the range of, 13 to 16?
It's incredibly expensive. You're paying a high-growth multiple for a company that today is reporting shrinking revenue and has gross margins under 25%.
And if you compare them to the big behemoth in the government AI space, the contrast is pretty stark.
Oh, it's night and day. That other company did over $1 billion in revenue in Q3, grew 63% year over year, and their gross margins are above 80%.
So this valuation is pricing in perfect execution of the pivot, not the current reality.
Exactly. And that structural problem that caused the Q3 revenue dip, customer concentration, that's still very real.
Absolutely. 4 major clients are 52% of their revenue. We saw what happens when just one of those Army programs shifts a little.
And that means this whole rally might be based more on, speculative hope and momentum than on a proven scalable model that actually justifies that kind of multiple.
Well, speaking of volatility and momentum, this is where the story gets really fascinating. That recent sharp drop in the stock price, the one that pushed it down below 555. There's a pretty controversial narrative around that.
There is. A lot of retail market watchers are claiming that drop wasn't just, organic profit taking after the good news. They're alleging it was a coordinated tactical move.
Yeah.
An algorithmic attack to suppress the price.
Okay, so let's break down this theory. They call it the bait and trap mechanism.
Right. So the good news, the acquisition announcement, that's the bait. It draws in all the retail buyers, pushes the price up towards $615.
And once there's enough of that buying volume, the institutions allegedly come in and execute massive short positions right into that strength.
They're shorting into strength, exactly. They sell huge blocks of shares when the most enthusiastic buyers are active and just overwhelm the momentum.
And there's this idea of premeditation, right? Some people pointed to a recent SEC Form 144 filing.
Yeah, that was a notice of intent to sell restricted shares from a derabber. The theory is that it was signaling a huge sale-off was being prepared, just waiting for the right moment of retail excitement to provide the liquidity.
But how do you dump millions of shares without crashing the price on the public exchange and causing a panic?
That's where the tools of the trade come in, specifically dark pools.
The private exchanges.
Exactly, private off-exchange venues. An institution can sell millions of shares there without the public seeing the order. On the day in question, over a third of the total volume reportedly happened in dark pools. It lets them execute these huge sales in secret.
So they can push the price down carefully without a visible meltdown until they hit that critical 550 level.
And that was the tactical goal, according to this analysis. It wasn't just about profiting from the drop from 615. The real goal was breaking that 550 support zone to kick off the next phase. Liquidity harvesting.
Let's unpack that. Liquidity harvesting is kind of a brilliant and brutal example of weaponizing investor psychology.
It is. So many retail traders, what do? They set automatic stop-loss orders just below a key psychological level, like 550.
A safety net.
A predictable safety net. If institutions can force the price just below that level, it triggers a cascade of automated selling from all those stop losses. Suddenly, there's a huge supply of cheap shares flooding the market.
And right at that moment, the same institutions that started the short attack can step in, buy up all those shares at a huge discount, and cover their shorts for a massive profit.
They literally weaponize the risk management strategies that everyone thinks are safe.
It turns the stock chart into a battlefield. So for investors watching this, what's the signal that the, quote, attack has failed?
The technical analysis points to one clear thing: a solid 4-hour candle close above that $6 to $6.15 resistance zone.
And what would that show?
It would indicate that buyers have finally absorbed all that selling pressure. It would signal a real structural shift in control, away from the short sellers and back to genuine buying interest.
The complexity of all this is,
Yeah.
it's just a powerful reminder of who you're up against in these markets. Whether you believe it's a deliberate attack or just heavy institutional selling, it really highlights how retail strategies, like predictable stop losses, can become visible targets.
It is a fascinating dynamic to track, and if the success of a tactic like this relies on breaking those predictable support levels, it really makes you question the fundamentals of automated risk management. The question for every retail investor isn't just where you set your stop loss, but maybe if you should be setting one at all in this kind of environment.
Thank you for tuning in to Investing Talk podcast. If you enjoyed this analysis, remember to subscribe for more insights into the companies moving the market.